Good everyone, and welcome to the business section of the Elite Tutor, where learning is made extremely very simple. And in today's video, we are going to be looking at the concept of national income accounting. And we're also going to be looking at this concept. We're going to be looking at various concepts under the national income accounting and also method of measuring national income accounting. So I want you to follow to the end. Now, when we say national income accounting, what do we mean? National income accounting can simply be defined as the ways or means of computing or ascertaining the total money value or the total monetary value of goods produced within the country or income earned within a country in a particular period of time. When we say national income accounting also takes into consideration the combination of income from private business, government, and also goods and services. Now, we can't talk about national income accounting without going into some key concepts on that national income accounting. And WAEC love asking questions from this concept. So I want you to pay attention. Now, the first concept we are going to be looking at the concept of gross domestic product. Now, when we say gross domestic product, it takes into consideration the total monetary value of goods and services produced within a country. Now, I want you to pay attention because there is a difference between our gross domestic product, which is the GDP, and our gross national product. Our first concept here, the gross domestic product, it takes into consideration the total monetary value of goods and services produced within the country, but our gross national product, it takes into consideration the total monetary value of goods and services produced within the country and also investment abroad. When we say investment abroad, we are simply saying it's same thing as net income abroad. Now, if you want to calculate, there are times when we'll be asked to calculate our GNP. Now, if you want to calculate our GNP, we have our GNP. We can go ahead to calculate our GNP as we have our GDP plus net income abroad. So you can see, why is it that our GDP, the formula for calculating our GNP is GDP plus net income abroad? Because our GNP takes into consideration both within the country and also investment abroad. Very, very important. And also we have the next concept. We have net national product, NNP. Now, firstly, why is it called the net? The first word here we have net. Now, when you say something is net, just as if we have in accounting, just as if we are making use of the word net income. When we say net income in accounting, we are simply saying that what expenses has been adjusted from that income. Now, in the case of our net national product, we are simply saying that what depreciation on the consumption of capital goods has been adjusted on our national product. So when we say net national product, we are simply saying the gross national product, the difference between our gross national product and the depreciation on our capital goods. That gives us our net national product. In simple terms, our net national product, it's simply the value of goods after depreciation has been deducted. And when we are talking about depreciation, we are simply saying the depreciation on capital consumption. Very, very important. So we have that our net national product, it's simply our net national product, it's simply our GNP minus the difference between our GNP minus depreciation. Depreciation on capital consumption. So someone will ask, why is it that our net national product, the formula is, why is it that our net national product, the formula is GNP? Why not GDP? But now let me show you something. Don't forget, this is net national product. There's a reason why it is there's a reason why it is not called net domestic product. It is called net national product. And that is why, in order for you to, the formula for ascertaining a net national product, it is our GNP, gross national product. And also don't forget, your gross national product is a factor. It comprises of both our GDP and net income abroad. Now we've looked at this concept. Now let's look at method of measuring national income. Very, very important. And I don't want you to miss any of this method. Now the first method is the income method. The first method is the income method. Now what do we mean by this income method? Now this income method of measuring net national income, it talks about the total monetary value of income earned by workers. And this income earned by workers, we are looking at their wages and salaries. We are looking at rent on land. We are also looking at interest on capital. We are also looking at profit. We are also looking at profit from entrepreneurs. Our income method, it takes into consideration the various income earned by workers. And also, it is also very necessary for you and I to understand that in order to avoid double counting under our income method, what do we do? Transfer payment such as payment to old people or payment to beggars are not to be added as part of our income method. Now, why is it necessary? Now, let's say, for example, I receive $100 as my salary, and out of that $100, I decide to give an elderly person $20, and probably a beggar $20. Now, what have I done? I have given out $40 from where? My income. My income has already been counted under the income method. It is not good again to add the income received from the elderly ones and also from the beggars. Why? It is coming from what me. It is already part of my income. So that is why, in order to avoid the error of double counting, transfer payments such as payment to elderly, to old people or beggars are not added on our income method. Now we move to the second concept, the second method. Now we have the output method, which is very, very important. Now, when we say output method, this output method, it takes into consideration the value added method in terms of measuring national income accounting. Our output method, it takes into consideration the value added method of measuring national income accounting. Now, what do I mean by this value added method? This value added method, it's simply the cost of output minus the difference between the cost of output and the cost of input. Very, very important. Now, let's say, for example, if I'm to manufacture bread, we are looking at the output method. If I'm to manufacture bread, the cost involved in the production or manufacturing of bread, that's our input. If the input is $1,000 and the output is $2,500. Now, the output method of measuring national income accounting, like I say, it follows the value added method. What is this value added method? The difference between the output and the input. So our value added method, which you can call VAMP for short, our value added method will have that this is $2,500 minus $1,000. And this gives us $1,500. So the output method here is $1,500. So this output method, it takes into consideration the value added, what? The value added measurement. Now, also, in order to add to this our output method. Now, this our output method, if you look at it from the marketing angle, it can be seen as our selling price. Why am I saying so? Because our selling price is a function of our cost price plus profit. Because the difference between your selling price and your cost price is your profit. So the difference between the output and my input gives us our value added, measurement, which is our output method. And finally, our expenditure method. Now, I want you to pay attention in this expenditure method. Why? Whenever WAEC sets their question on calculation involving national income accounting, most of their calculation question comes under this expenditure method, and which is very, very important. Now, when we say the expenditure method of measuring national income accounting, the expenditure method talks about the expenses incurred in investment and consumption purpose. This expenditure method of calculating national income accounting, it takes into consideration the expenses incurred in consumption and investment purpose. The expenses incurred by household or firms, and also government consumption and also investment. And also the formula for calculating our national income accounting under our expenditure method is as follows. Please follow closely. For expenditure method, we have that for expenditure method, the formula is, we have national income accounting is equal to C plus I plus G plus X minus M, less we have subsidies plus taxes plus depreciation. Now, in order for us to calculate our expenditure method, we are going to be making use of this formula where our national income account is equal to our C. Our C stands for consumption, plus I. Our I stands for investment, and our G stands, when we say investment, so our G stands for government consumption, and our X minus M is simply our net export, which is simply our export minus import, and then we less the addition of our subsidy plus taxes plus our depreciation. And also, can I also tell you something? There are times when you'll be solving WAEC questions and then you don't have your subsidy, taxes, and depreciation, and you are asked to calculate your national income. In those scenarios, what do? You just need to add this, and that gives you the value of your national income based on the question. We've come to the end of this video, and I want you to watch out for part 2, because in part 2, we are going to be solving a WAEC standard question involving the expenditure method. And also, in addition, I'm also going to be solving a question involving our marginal propensity to consume. We are going to make use of the multiplier. So watch out for part 2. Thank you very much. Hope you like this video. Ensure you like and share. Thank you.